A very warm welcome to This is the Business Hour podcast. My name is Jimmy Bogo. Welcome to the program. Now, today we will be speaking to Edwin Thiong'o, who is the General Counsel for PANGEA, both Accelerator and Trust, and we will be telling you what these are. But first, let's take a look at our day's quote. And it says, "Every problem is a gift. Without problems, we would not grow." That is by none other than Anthony Robbins. All right, Edwin, karibu to the program.
Thank you, Jimmy.
Who is PANGEA and what does PANGEA do?
Right. So PANGEA is a Norwegian-based entity, and when we use PANGEA, we try sometimes separate between the accelerator and the trust.
Yeah.
But they have a history in terms of how they were established. So PANGEA Accelerator was first established to try a bridge the space of fundraising for startups, and we began this as a for-profit organization.
Mm-hmm.
But over time, to serve the market much better, it became important for us and prudent for us to be able to expand our scope and reduce our tax structure so that we're able to trickle down much more finance into startups. And that's how the concept of PANGEA Trust was born. And the PANGEA Trust is a not-for-profit.
Yeah.
But PANGEA Accelerator is a for-profit organization that is also value-driven and trying to work with entities that are at the growth stage, rather than PANGEA Trust, which is working with companies that are at the starting stage or pre-revenue stage. So that's the main difference. But of course, in terms of the structure, we operate as totally different entities.
And it's a good thing that you've mentioned about fundraising.
Mm-hmm.
And the question that comes to mind is, where do you fundraise for? Because again, a lot of startups struggle with raising capital. They struggle with just getting enough donors or people to invest in them.
Mm-hmm. So the over the last couple of years, I think there has been tremendous growth in terms of funding availability. We've had a lot of companies who are willing to just put in money in the form of private equity.
Yeah.
And therefore the sources of funding, and first maybe to just break down how the ecosystem looks like. So the startup ecosystem has different players, and different players do different things for purposes of guiding towards fundraising. So you have the incubators, and the incubators are entities within the ecosystem. So I belong to an incubator called Lighthouse Trust, and the incubators usually offer technical support. We do not offer financial support. We do not offer acceleration and that kind of support. And incubators are important for startups that are starting out, because it is from incubation that the discussions around fundraising begin.
Mm-hmm.
And when you're incubated, and there used to be a lot of incubators, I think the inceptors of the startup ecosystem in Kenya were incubators, who over time have now metamorphosized to become, their model has become more real estate, where they offer space for hire and so on and so forth. Mm-hmm. But the primary objective of incubators was to make sure that startups get support to begin the conversations for fundraising. Then you have the accelerators, and the accelerators is like what PANGEA is doing. The role of the accelerator is to simply take a company, put it together, train them in terms of putting documents together, polish them up, so that eventually they can have investor-facing discussions.
All right, and it's actually a good thing that you talked about. You touched on putting it together, because then that was actually my next question.
Mm-hmm.
When you, throughout your interaction with these startups, what has been the one thing that stood out for you in terms of these are the areas that a lot of startups are getting wrong?
Well, I think the biggest challenge is many young people are setting up businesses to make a living. And when you try to do that, the business is likely to turn out to become an SME. And you see that when you distinguish what an SME is from a startup, you'll find that an SME is purely a for-profit business that impact is not essentially impact-driven, it's driven by profits.
Yeah.
It is the bottom line that matters most. The biggest challenge we've had, and this is a problem in Africa and also in Kenya, is to try transform SMEs into startups. So you remember that startups, for example, our method of accounting is very different.
Mm-hmm.
And startups do not necessarily strive to make a profit. In fact, startups strive to create impact and be value-driven. And that's why sometimes you'll find companies like Amazon, who've run on the startup model, have existed for many years. I think it's only in 2016 that they say they've made their first profit. And perhaps you'd ask, how then have they been running all this time and yet you expect that they are existing for profits? And trying to create that structure has been the biggest challenge. And you'll find that sometimes when you want to fundraise and yet you're not ready in terms of structures, then you'll not be able to answer questions such as, what kind of shares are you giving up? Do you have preferential shares? Are you going to get into a safe agreement with investors? And those are the discussions that complicate the process of fundraising. And I don't think we have ever had a challenge of ideas. The entrepreneurs who are in this space are extremely brilliant. It's a question of just how they structure it for it to become an investable business case.
All right, and I think when you talk about structures, you'll find that most of these startups are individual based. I have this idea, I try and put some money into it and register a company and say, okay, now I'm good to go. But ideally, should that be the case, or are there elements that are actually missing besides just the idea?
And that's a very good question, because it's also another discussion that in specific ecosystems, like for example in Silicon Valley, in some parts of Delaware, where the startup concept began, you'll find that entities such as Y Combinator, which is among the biggest startup schools or the biggest accelerators for startups, they will insist that they will not fund a business unless the founder has a co-founder, for obvious reasons. The more people in a startup, the likely it is to focus on impact. And the fewer it is for people in any form of business, the higher chances of it focusing around the lifestyle of those who own it. And that's a big distinguishing factor between an SME and a startup. And you'll find many SMEs do not even need to be registered corporate entities. It can be a sole proprietorship that is raking money in the millions. But it's not scalable. We can't scale it beyond that because it is to support the lifestyle of an individual. So it is always advisable. And what we've observed over time is always advisable for co-founders to partner, not for convenience, but for strength. For example, one person will be good at tech. Another person is very good at admin, marketing, and so on and so forth. So you want to be surrounded by founders who are able to bring in a rare skill so that you're able to move the startup much, much faster. So it's advisable for you to be more than one so that in terms of scaling, it becomes an easier conversation.
And okay, let's stick to that issue of scalability. There are elements that I'm sure you look at to be able to determine this business has a potential to be scaled up. What are some of those things?
So the bedrock of all businesses are what you call the 3 Ps of due diligence. We want to discuss people, processes, and the product. And those 3 levels must make sense. But you realize we focusing on people will not focus on how big the team is. We're actually focusing on how resourceful is the team. So there are startups, for example, that we want to see that the key strengths required for you to scale that business are present. If you're running, for example, a podcast like yours, content development is a key pillar for it. The host must be a key pillar. So if you want to invest in the podcast, then I'll ask those questions. In terms of people, have we figured it out? And you want to figure it out because you do not want the core team of the startup to be employed. You want them to be the co-founders. Because remember, we are scaling this business and therefore we need the levers intact. But many organizations perhaps will only have a good founder, but the other levers are missing. So they keep having a high traction of people. So one of the things you want to do and one of the things you focus on when it comes to people is to insist that the early stage employees, those who make the startup work, then perhaps you need to create an employee share ownership plan for them so that they stick long in the organization to enable investors like ourselves benefit from the investment we make. The second one is product. On product, we actually try and insist, depending on the startup piece, if the startup is a pre-money startup, meaning that it has not turned revenue, or rather these books are still red, which is very common in the startup ecosystem because we spend a lot of time doing venture building. And we put in a lot of money in capital expenditure rather than operations. So therefore, we are unlikely to be turning profits as much as an SME would. But in the product, we look at whether the product you've developed an MVP, which is a minimum viable product. That minimum viable product is tested based on market reception. Have you taken it to the market? What has the market said? What are the key learning milestones you've learned? And then you are able to move it forward. And of course, the processes. And the processes are important because they tell us how decisions made, how do you determine capital investment, how do you determine OPEX, and so on and so forth. So if you figure out those three pillars, then all other small levers that are tied to them are easy for you to start discussing as you get deeper into the fundraising conversation.
All right, just before we move on to the next topic of discussion, I just want to take this opportunity to remind our viewers, whoever you are, wherever you're watching us from, please make sure that you subscribe and click the bell icon to make sure that you get notified every time we have a new episode coming on. So, Eddie, let's move on. In terms of raising capital, I know this is one of the biggest strengths of PANGEA. So, what is your capital raising process? What does it look like?
Right. So we ordinarily have cohorts, and we take in entrepreneurs in cohorts. So I say when we discuss fundraising, because fundraising is a process that is an elaborate process, starts from the time you start doing ideation all the way to when you bring in the first investor, either pre-money investor or pre-revenue investor or post-revenue investor. Ordinarily, you want to take these startups in cohorts. And I think it's only in Kenya or Africa we do that, because in other countries, people don't take them in cohorts. But we are taking them in cohorts because we need to do a lot of polishing. And that is what guys like us do. We sit with startups, identify the gaps, do due diligence, have discussions. This might look better if it's done this way, validate this for us. So the cohorts are important because PANGEA serves the role of bridging our investors with business cases that make sense. And therefore, we have a responsibility to make sure that by the time a startup becomes investor facing, we have actually dealt with some of the issues that are risk areas, that discount investment, that we deal with them at that stage. So the process for us is that you'll have call for applications. The call for applications are sent to a secretariat. The secretariat will filter through, go through the checklist, then we'll shortlist. When you shortlist, we'll do due diligence. And due diligence takes the form of going through what I've just explained, product, people, processes, financial pillars, and so on and so forth. Then we have a report. That report ordinarily will identify some of the gaps that need to be worked on. And many times these gaps become then conversations for fundraising. So fundraising doesn't happen in one tranche. There's no investor who will tell you need $1 million is $1 million. Only maybe someone who's really not keen on recovering the money. But it's rolled out in tranches, and these tranches are tied to milestones. For example, if the due diligence report said you need to figure out your financial model, the moment you figure out the financial model, then you unlock a new tranche of funding and so on and so forth. So in a nutshell, that's how the fundraising process looks like.
All right, because whenever I've had any conversation around PANGEA, what comes to mind is Shark Tank. And I'm thinking, here comes an entrepreneur who has this great idea, but again, they do not know how long this process is going to take. And maybe that can be one of those factors that discourages them, let's say, to come on board. So from where you sit as an investor, is this process necessary? And for them, is it something worth the wait?
Well, absolutely. And I'd give you some interesting facts. So there are very few companies in Kenya who've raised what you call a Series A fundraising. And Series A fundraising is actually a ticket size of $1 million going up. Most of the fundraising we have going on is called angel investment. And angel investment is guys like you and I, Jim. You like this mug of coffee, you think it's a nice mug of coffee. From my salary, I'm able to take a certain amount of it and invest in these guys and support them. You are unlikely to ask the tough questions. Because you understand these guys are at the formative stage. So why this conversation is extremely important is because without you figuring out these tough questions, then you're not able to sustain a board of directors who come in after Series A funding, because these are people who are keen on recovering the money. So it takes a bit of time. But I don't think startups can blame the process. They essentially blame themselves, because if you come well prepared and you did all your work from the get-go, then it will be easier for you to have conversations that lead towards Series A funding, because then we do not have a lot of time to spend with you on ideation, correcting this, correcting that. And some of the mistakes are technical mistakes. For example, you have not kept a proper P&L
Yeah.
It's a no-brainer. No investor will invest if you don't have a good P&L. But if we have to start working on the P&L, then of course it takes a large and inordinate time for you to get across the door for investment. But I think, in my view, it is better for you to take smaller steps, so that when you onboard your board of directors or new investors, you can sustain the conversation long term.
All right. So if I'm getting you correctly, what you say is get your basics right, and this process becomes easy.
Absolutely.
All right. Because then here comes a question on at what point do I, as an entrepreneur or a startup, need a board, and who do I need to have on this board?
Yeah, good question. And by the way, it's just something I think today we'll have a lot of fun facts. So another fun fact.
Yeah.
So many startups have boards, and people say this is my board, but boards are of different types in the corporate space. So an advisory board is not essentially a board. These are peers who mean well. They have no voting rights in your company.
Yeah.
I mean, if you decide to do business that doesn't make sense, these guys will only sit and tell you, our advice is this. Whether you take it or not is entirely up to you. But the board of directors, if investors are onboarded as equity owners in the business, then they have voting rights. I mean, if you've read the autobiography of Steve Jobs, he got kicked out of his own company. It is that board that kicks you out of your company. The board where people have put in their money. But a lot of entrepreneurs in Kenya have advisory boards, and they're nice, and they sit in many of those advisory boards.
Yeah.
That we say advisory boards are as good as the willingness of the investor. So you need an advisory board when you're starting. And my advice is that try get an advisory board that has people who do not know you. So I see a lot of guys tag along, their friends. It becomes another place where people drink coffee and praise you. We need people who ask you the tough questions.
Yeah.
This doesn't make sense. And it is that sharpness that makes it possible for the process of the business to be able to accommodate even future investors and still run without changing the business model.
And Eddie, again, I'm thinking from an entrepreneur's perspective. I have this business idea that I know has the potential to be scaled up. What is the safest equity trade I can do? How much equity should I be willing to let go in exchange for capital?
Right. So a number of things determine issuance of equity. So first, the stage of the business. So I've always said that when a business is at the early stage, you're even not sure how big this business will be. And therefore, you have no business promising anyone equity. Because see, the more equity you give, the more control you cede. And the more equity you give and the more shares you issue, the more you dilute yourself as a shareholder. So find that in a board of 7, you only control 2 seats. It's no longer your company, is it? And many times that can go with your vision. So the discussions around equity depend on where the company is. So for companies that are early stage, these are companies that are still figuring out the minimum viable product, they're still testing the market, they're still validating the concept. It is always advisable, if you want to bring on board investors, you enter into what you call a safe agreement. And safe agreements are agreements that promise issuance of equity, but do not actually issue equity. And equity is issued at a later date. That gives you significant control of the innovation process until when you're ready to onboard investors. So if a company, for example, has gone through that process, and now it's at a place where they're facing investors and are willing to give equity, the discussions around equity are determined by valuation. So you need to work out the valuation of the business. And valuation for startups, many times we use comparables. And we use a method called EBITDA multiples, and we're able to say, if I compare myself with company X, which has the same EBITDA multiple, then its value is more likely to be my value. Then the investors now will come and discount risk. So you want to have conversations for equity issuance once you figure out the business, because the discount on risk is based on the 3 elements I told you: product, processes, and people. So an investor will say, well, you have a good product, but I do not see like you have the key team. And therefore I'm negotiating my discount rate at 20%. Because essentially he's pricing for his risk. So it makes it easy for you to figure out these things, so that when you're issuing equity, you are able to issue equity based on the correct valuation, with minimal discounting for risk.
Because what I'm looking at is you have an investor who, let's say, wants to invest in exchange for equity, but once you've sold them this business idea that you have, they actually realize, oh, we're actually onto something here, which means they will want more shares, but not put in enough capital or even double the amount that you were asking for. So isn't that a sign that maybe it's time for you to relook at your business model or the kind of partners that you want to bring on board?
Yeah, absolutely. And it's the nature of capitalism, and the rule of capitalism is that for every shilling you make, someone must lose it.
Yeah.
And that's the name of the game. If we realize you have a good idea, it's called information asymmetry. The reason, for example, why you want to pay for bread at 10 shillings is because the owner of the bread knows it's not worth 10 shillings, is it? And therefore they leverage on the lack of knowledge of the correct pricing. It's the same thing in the fundraising market. Investors want to pick businesses at a price that enables them to reap maximum benefits out of them. Therefore, and you raise a very fundamental question, then it makes sense on the selection of partners and when to select them and when to onboard them. So it is not enough to simply say, I want to raise $1 million. You will not take it from the next person who gives $1 million. In essence, you have to evaluate what type of investor is this, how long are they going to be on board, what external value do they bring apart from just $1 million. So when you start getting a lot of interest, and a lot of startups, when startups cross a certain level of efficiency, they even don't need to apply for fundraising. We, for example, scout them. And in the market we scout, there are startups that have been funded by almost every player in the ecosystem. And it's because they've crossed over that space. But they also now struggle with the decision of determining who is the right investor and when is the right time to seed shares and so on and so forth.
We just want to take this opportunity to remind you that these recordings are currently going on at Workstyle. Okay, this is a co-working space along the Waiyaki Way. This is at Muthangari Drive. That is where you'll find Workstyle at the address Muthangari Drive on 7th floor. And that's where we do all our recordings. They have fantastic facilities right here that you will be able to see as we go along. So Eddie, back to our conversation. There's the issue of this is actually a safe investment. Now you've done your due diligence. At what point then do you determine we can only put in X amount of money?
So all investment in startups usually are negotiated through a document called a term sheet. And therefore the term sheet helps us identify what are the pros and cons of this investment. And it's a document that actually contractually binds the investors to the business and vice versa. So determining whether an investment is a safe investment. So we mainly will use a financial forecast. And the financial forecast is to help us simulate the business. So for example, I take an example, maybe and it's a bad example, assuming the startup is selling mangoes. And I tell them, how many mangoes do you sell today? They say 10 shillings. But for me to invest, and I know my recoup period is 10 years, I must make the decision whether in 10 years, it will be viable to sell mangoes. And therefore, as an investor, I'll not look at how much money they're making right now. And remember, I told you that this is not SME thinking, is startup thinking. We're thinking about long-term value creation. And by thinking that way, I'll simulate it into a model and I put them for 10 years, and then I'll start factoring in changes in circumstances. I'll factor in the economical changes in pricing, for example, right now, supply chain issues. And I'll be able to say on the 10th year, if I put in my money right now, then on the 10th year, I'll be able to get my money back. So usually use a base called, a formula used the internal rate of return. It tells you, if you give me 10 shillings today, in 5 years, how much will it be worth? If the internal rate of return is negative, it's a bad investment. You should not even care about it. Secondly, if it's not above the treasury bill rate, which is 12, which I think right now, around 12% or thereabout, I'm not sure. If it's not above that, then as an investor, I have to say, if I give Jim my money, it's going to come back with less than 12%, then why would I give him my money? I would rather put it in the bank and earn the same amount of money. So it is those marginal returns you look at for you to say this is a safe investment. And of course, what you call the growth milestones is what you'll use. So once you figure out those things, you are going now to go into the term sheet and negotiate and say, we are going to invest. But to de-risk our investment, we'll invest in these small portions, what I was telling you, tranching it out, so that at the end of it all, we do not risk our money. And of course, the startup also does not bind itself to commitments it can't keep.
All right, and I remember the last time we had a conversation with some of your colleagues from PANGEA. One of the key things that actually stood out for me is the fact that a good percentage of diaspora remittances goes into consumption and not investment. Has that changed? And how do we then get these Kenyans who are in the diaspora to invest more in local companies?
Yeah, and sadly that it still hasn't changed. The
What
balance
are the percentages now?
It's been a long time since I checked, though I know the numbers are still very vague in my head.
Yeah.
But what I know is that the central bank has been doing an analysis on diaspora remittances, and the facts stand as they are. A lot of Kenyans in diaspora are sending back money for consumption, and if it's for capital investment, it's actually in real estate.
Yeah.
But the challenge has been that the market in real estate has either become too fraudulent or has become too illiquid. And therefore, there are a lot of guys who own apartments that return nothing for them. So what we've been doing as PANGEA, and I think we began this discussion in 2020, just after COVID, is to try come up with a system whereby diaspora remittances are put in a structured manner for investment. So the challenge is why if you have a sibling who's in the States or in the UK, they not invest in the business in Kenya, is because first, there is no structured way of investing in that business. It could be someone wants to defraud them, so they are very apprehensive.
Very skeptical.
So we've come up with a platform called PANGEA Connect. And PANGEA Connect is a platform that is working more or less as a crowdfund, where we do our due diligence, we pre-qualify startups, and also to reduce the lag time for startups to wait for fundraising, they can actually get to a platform where the investors can access them directly. So PANGEA Connect is actually live. We've been testing this with we got approval from the Capital Markets Authority, and we are trying to have discussions around joining their sandbox. But we think that by channeling diaspora remittances to venture building, then we can actually try reverse the curve of how much is spent on consumption, and also teach our people that actually by supporting startups, you create employment for your children, your siblings, your communities, and so on and so forth. So it's unfortunate we are not there yet. But I mean, we must start from somewhere. I mean, people are working hard. And I think the same discussion has been taken to Somalia and Ethiopia. We also have work we're doing there. And I think African-wide discussions around diaspora remittances are also becoming very interesting for embassies and presidents to start weighing what makes sense.
I think they're actually taking center stage because most of these citizens that are living in the diaspora, one of the biggest concerns they have is, I would want to invest back at home, but I don't know. I don't have someone I can trust to do that for me. So I think we need to, and especially companies like yourself, you need to look at ways in which you can be able to harness all these monies that come from the diaspora. They're put in the same kitty, and then it can be invested, let's say, through what some of the projects that you've been doing. One of the things that I would really want you to help our listeners or our viewers today is, how do I know that I actually got a good deal? I've gone through the process, you've done your due diligence. What is a good deal from where you sit as an investor and for me as an entrepreneur?
A good deal in the fundraising space is like a good marriage. It's not really. It's not really what your partner gives you. Is how convenient the relationship is for you. Therefore, when we evaluate the success rate of investment, sometimes it doesn't really have to be how much money you got. Because, you can get a bad spouse. They are the most beautiful, but they are an extremely stubborn spouse. So a good investment in the startup space, unlike in the SME space, is one that propagates growth. And how you assess you've gotten a good deal is if the people who are joining your investment, joining as investors, are very supportive in your board. And secondly, if you can get an investor who is happy to spend time, not only will give you money, but spend time with you to help you figure out some of those issues, you have a good deal. If you can get an investor who's in adjacent markets, so assuming you're in manufacturing, they're good distributors, then that's a good deal because they actually help you build traction in the market. And you find, for example, in famous TV shows like Shark Tank, it is always a winning discussion if the Shark says, I'm going to work with you. I'm going to bring in my team.
Yeah.
Because that is the essence of a successful startup investment. For the SME, it is the interest rate that matters. And that's why I say if you're an SME looking for financing, please go to a SACC or a bank. Because the space you're in, you'll be measuring whether I'm able to pay, whether the interest rate is better between this and this. Nobody cares whether your bank is going to support you. In any case, the bank doesn't care about you. All they care about is their collection. In the startup space, it's the synergy between the investor and the business that makes it a perfect investment.
All right, final words. I know you've seen a lot of entrepreneurs and a lot of startups fail. Maybe a word of advice, what do they need to get right even before putting themselves out there for an investor?
I think in very few words, ideas are not investable. So a lot of young people and a lot of entrepreneurs spend a lot of time building ideas. I think for me, what has worked over the years is to begin validating your idea way before you invest in it. If I say I want to make a system that does XYZ, before I even commit my money into it, I validate it. And we have what you call ideation. And an ideation is actually a thing that many companies skip. So if you have an idea and you don't want to burn your money or burn your time, ideate first. Then the ideation framework will tell you whether you have a good business or a bad business. If it's a bad business, please kill it early and start afresh. The biggest disaster is to work on something that is not validated. Only when it is put before an investment platform, it is stretched and breaks into pieces. I think that is more heartbreaking than actually saying it was a bad idea, let's kill it. And a lot of entrepreneurs fail to go back into investments, into entrepreneurship, if they have held on to a false idea for a long time. And sometimes they'll not be happy with people like us who will do diligence and say we don't see anything there, but
you basically tear it into shreds
and absolutely
holes.
And for sure, and that's how it should be. We need to be a country that is producing amongst the best of the best startups. We need to be a place where if investors know if it's a Kenyan business, you won't go wrong. I mean, globally now, Africa, some parts of Africa, for the avoidance of being backlash, there's some parts of Africa where investors are very skeptical. Because essentially, the ideation is wrong, but people are actually now twisting and turning to validate bad ideas for investment. And if we do that as a country, definitely, the private equity market that is booming right now will start shrinking, and we'll have more investors insisting to invest in their own countries.
All right, I don't think I have anything more to add to that. Saying thank you so much for coming to the show, and I'm sure we'll be having you back on very soon to be able to discuss other ideas and just things to do with startups, and also just putting some of these questions that are coming from these startups and these entrepreneurs, because I know most of them, this is information that they would want to have.
Absolutely.
Thank you so much, Eddie, for coming.
Thank you too. Again, it's such a pleasure to be here, and I think you guys are doing a tremendous job.
Really appreciate it.
There are a lot of people who don't know the knowledge you guys can offer, and I think this is a space that more of us need to come to and discuss these things. Thank you for even considering me to join your podcast.
It's our pleasure. And that's all the time we have for you tonight. And like we always say, every hour is business hour.